What if I told you that while one superpower is defying all economic expectations, global growth forecasts are painting a completely different picture? And what if I also told you that the decisions made in boardrooms and central banks this week could determine whether your portfolio thrives or struggles for the next 2 years? Welcome back to Finance Focus Weekly. Here in InfoExpress, and today we're not just covering the news, we're connecting the dots between global economic shifts and what they mean for your financial future. This week has been absolutely wild for anyone watching global markets. We've got China posting numbers that are making economists rewrite their forecasts, central banks making moves that caught even seasoned traders off guard, and a major IMF report that's essentially a warning shot to the world's biggest economies. But here's what makes this episode different. We're not just going to tell you what happened. We're going to show you exactly how to read between the lines, spot the opportunities everyone else is missing, and position yourself for what's coming next. So whether you're managing a portfolio, running a business, or just trying to understand how these global shifts affect your daily life, grab your coffee, hit that notification bell, and let's dive deep into the 15 minutes that could change how you think about global economics forever. Let's start with something that's got me scratching my head, and it should have you asking questions too. We've got two of the world's most respected economic institutions looking at the exact same data and coming to radically different conclusions about where we're headed. On one side, the International Monetary Fund is projecting what they call steady global growth at 3.3% for both 2025 and 2026. That's essentially unchanged from their October 2024 forecasts. The IMF's logic? They're seeing upward revisions in the United States that are offsetting weaknesses in other major economies. But then, and this is where it gets interesting, the World Bank drops what can only be described as an economic reality check. They're forecasting global growth to weaken significantly to just 2.3% in 2025. We're talking about a full percentage point difference here, folks. Now you might be thinking, what's 1 percentage point? Let me put this in perspective. That difference represents roughly $1 trillion in global economic activity. That's the difference between recession fears and cautious optimism. So what's really going on here? The IMF is betting on American economic resilience. They're seeing strong consumer spending, robust job markets, and technological innovation driving growth. The World Bank, however, is looking at the same data and seeing unsustainable debt levels, geopolitical tensions, and structural problems that aren't going away. For you as an investor, this isn't just academic debate. This uncertainty is exactly why we're seeing increased volatility in global markets. When the experts can't agree on the basic direction of the economy, it creates opportunities for those who can read the signals correctly, and traps for those who can't. My take? Both institutions are probably partially right. The US might outperform while the rest of the world struggles, creating a two-speed global economy that we haven't seen since the early 2000s. Now let's talk about the story that's got economists around the world doing double takes. China just posted GDP growth numbers that shouldn't be possible given everything we know about the current trade environment. Here are the numbers that matter. Chinese GDP surged 5.2% year-over-year in the second quarter of 2025, with a solid 1.1% quarterly growth. Now, if you've been following trade tensions, you know that exports to the US fell sharply during this same period. So how exactly does an export-dependent economy grow when its biggest customer is buying less? The answer lies in three key areas that most analysts completely missed. First, China's domestic manufacturing sector is absolutely crushing it. We're talking about production levels that suggest they've successfully pivoted from export dependency to domestic consumption in ways that seemed impossible just 2 years ago. Second, retail sales are not just healthy, they're robust. Chinese consumers are spending money like they believe in their economic future. This is huge because consumer confidence is often the best predictor of sustained economic growth. Third, and this is the part that should make every global investor pay attention, China is proving that the old rules about trade dependency might be completely obsolete in a digitally connected economy. But here's what's really fascinating from a strategic perspective. While US-China trade volumes are dropping, China's trade with the rest of the world is actually increasing. They're not just diversifying their trade partners, They're creating entirely new trade corridors through initiatives like the Belt and Road program. What does this mean for your portfolio? Well, if China can maintain this growth trajectory while being partially decoupled from the US economy, we might be looking at a fundamental reshaping of global supply chains. Companies that position themselves in these new trade corridors could see massive opportunities. But there's a warning here too. This level of growth amid trade tensions suggests China might be using fiscal stimulus that could create problems down the road. Debt-fueled growth has a way of catching up with even the most sophisticated economies. While China's grabbing headlines with growth numbers, there's a quieter but potentially more important story playing out in central bank boardrooms around the world. This week gave us a masterclass in monetary policy signaling that every investor needs to understand. Here's what happened. We saw at least one major central bank cut their benchmark rate from 5.5% to 5.25% following their July policy meeting. On the surface, they're calling this move consistent with lower inflation. But central bankers never just say what they mean, you have to decode their language. Let me break down what this really means. When central banks cut rates while saying it's because of lower inflation, they're usually telling you one of three things. Option 1, they're confident that inflation is under control and they can stimulate growth without rekindling price pressures. Option 2, they're seeing economic weakness that they're not talking about publicly. Or option 3, they're getting ahead of a global slowdown that they see coming. Given the mixed signals we're getting from growth forecasts, I'm leaning toward option 3. Central bankers have access to real-time data that the rest of us don't see for weeks or months. When they start cutting rates despite relatively stable economic conditions, they're usually positioning for something. But here's where it gets really interesting for your investment strategy. Rate cuts traditionally signal cheaper borrowing costs and higher asset prices. But in the current environment, with inflation still a concern in many regions and geopolitical tensions running high, the traditional playbook might not work. Let's talk about what this means for different asset classes. For bond investors, rate cuts typically mean capital gains on existing holdings but lower yields going forward. For equity investors, lower rates usually mean higher valuations, but only if earnings growth can keep pace. For currency markets, and this is crucial if you have any international exposure, rate cuts often weaken a currency relative to others, but if multiple central banks are cutting simultaneously, you get into a complex web of relative devaluations that can create massive opportunities for those who understand the dynamics. My prediction? We're at the beginning of a global easing cycle that most investors aren't prepared for. The central banks that move first and most aggressively will likely see the best economic outcomes, but their currencies might suffer in the short term. Now let's dive into a story that honestly didn't get nearly enough attention this week, but could be the most important economic development of 2025. The IMF released their external sector report, and buried in the technical language is essentially a warning shot to the world's major economies. Here's what the IMF is really saying when they talk about post-pandemic domestic macro imbalances. They're warning that some countries are running massive trade surpluses while others are racking up unsustainable deficits. And if this doesn't get fixed soon, we could be looking at a crisis that makes previous trade wars look like, well, minor disagreements. Let me paint you a picture of what these imbalances look like in practice. You've got countries like Germany and China running enormous current account surpluses, meaning they're exporting far more than they're importing. On the flip side, you've got countries like the United States running massive deficits, consuming more than they produce. Now, these imbalances aren't necessarily bad in the short term. In fact, they can be signs of healthy global trade where countries specialize in what they do best. But when they become structural and persistent, they create what economists call unsustainable debt dynamics. Here's the scary part that the IMF is hinting at but not saying directly. When these imbalances reach critical levels, they don't correct gradually. They snap back violently. We saw this in the Asian financial crisis of 1997, and we saw it again in different forms during the 2008 global financial crisis. The IMF is essentially saying that if major economies don't start making adjustments now, through fiscal policy, monetary policy, or structural reforms, we could see continued current account divergence. In plain English, that means the imbalances get worse until something breaks. But here's where it gets interesting for investors who understand these dynamics. The IMF also noted that if countries do address these imbalances proactively, We could see convergence of major current account positions. That's economists speak for saying that currencies could realign dramatically, trade patterns could shift massively, and entirely new investment opportunities could emerge. So what should you be watching for? First, look for countries that start implementing serious fiscal reforms or structural adjustments. These could be early indicators of major currency movements. Second, pay attention to trade policy announcements that go beyond rhetoric and actually address these underlying imbalances. Third, and this is crucial, sectors that are heavily dependent on the current trade patterns could see massive disruption. But sectors that can adapt to new trade flows could see unprecedented opportunities. Here's something that either should give you confidence or keep you up at night. I'm honestly not sure which. Despite all the economic uncertainty we've been discussing, global markets have shown what can only be described as remarkable stability this week. Let me give you some context that should make you think. US tariff announcements that would have sent markets into a tailspin just 2 years ago barely registered a blip on trading screens this week. Currency markets that typically react violently to central bank policy shifts showed only modest movements. And equity markets seemed almost indifferent to the stark differences in global growth forecasts we discussed earlier. Now there are two ways to interpret this stability, and which interpretation you choose could determine your investment strategy for the rest of 2025. Interpretation number 1. Markets have become more sophisticated and efficient at pricing in complex information. Modern algorithms and institutional investors are better at distinguishing between noise and signal, so they're not overreacting to every piece of news. Under this view, market stability reflects genuine confidence in the underlying resilience of the global economy. Interpretation number 2, and this is the one that keeps me awake at night, markets have become dangerously complacent. We might be in a period where investors have become so accustomed to central bank intervention and government support that they've stopped properly pricing risk. Here's why interpretation number 2 scares me. When markets stop reacting to bad news, it's often because investors believe that authorities will always step in to prevent serious problems. But what happens when the authorities themselves are the source of the uncertainty? Think about it. We've got central banks cutting rates despite inflation concerns, governments running massive deficits while warning about fiscal sustainability, and trade policies that are creating the very imbalances that international institutions are warning about. There's a concept in market psychology called the stability-instability paradox. The idea is that long periods of stability actually create the conditions for instability by encouraging excessive risk-taking and reducing vigilance. So here's what I'm watching for as potential warning signs. First, any sudden spike in volatility, not because volatility itself is bad, but because it might indicate that markets are suddenly repricing risks they've been ignoring. Second, unusual movements in traditionally stable assets like government bonds or major currencies. Third, and this might be most important, watch for any signs that major institutional investors are changing their positioning dramatically. When the smart money starts moving quietly, it's often ahead of major market shifts that retail investors don't see coming. The bottom line, market stability in uncertain times can be either a blessing or a curse. For now, it's creating opportunities for patient investors who can identify genuine value. But if this stability is masking underlying problems, the eventual correction could be severe. Before we get to actionable strategies, there's one more story that deserves your attention, and it might be the biggest opportunity that most investors are completely missing. Buried in this week's economic reports was a projection that South Asia is expected to remain the fastest-growing region among emerging market and developing economies. We're talking about growth rates that average 6.2%, nearly double what developed economies are managing. But here's what makes this really interesting. This growth is happening despite what economists are calling rising global trade barriers and elevated uncertainty. In other words, while developed economies are struggling with the very trade and policy issues we've been discussing, South Asia is finding ways to grow anyway. The drivers of this growth tell a story that every forward-thinking investor should understand. First, massive infrastructure investments that are creating entirely new economic ecosystems. Second, a digital transformation that's leapfrogging traditional development stages. And third, demographic advantages that won't be replicated anywhere else in the world. Let me give you some numbers that put this in perspective. The working age population in South Asia is expanding at exactly the time when developed economies are dealing with aging demographics. That's not just a statistical curiosity, it's a fundamental economic advantage that could last for decades. But here's the part that most analysts are missing. South Asian economies are also becoming increasingly integrated with each other and with other emerging markets, creating trade corridors that bypass some of the traditional choke points that are causing problems for developed economies. Now, I'm not suggesting you should put your entire portfolio into South Asian assets, that would be reckless. But completely ignoring the fastest growing economic region in the world while focusing only on developed market problems would be equally foolish. The key is understanding that we might be witnessing a fundamental shift in global economic gravity. For the past several decades, emerging markets were essentially dependent on developed market demand. But what we're seeing now suggests that emerging markets might be creating their own demand dynamics. For investors, this creates opportunities in everything from infrastructure companies that are building these new economic corridors, to technology companies that are enabling the digital transformation, to consumer goods companies that are serving rapidly expanding middle classes. Alright, we've covered a lot of ground, and I know some of you are thinking, this is all fascinating, but what am I supposed to do with all this information? That's exactly what we're going to tackle right now, turning global economic analysis into actionable investment strategies. First, if this week taught us anything, it's that traditional geographic diversification isn't enough anymore. When the IMF and World Bank can't agree on basic growth forecasts, and China can defy trade war logic while developed markets struggle with basic policy coordination, you need what I call structural diversification. Here's what that means in practice. Instead of just spreading your money across different countries, you need to spread it across different economic models. Have some exposure to export-driven economies like Germany, some exposure to consumption-driven economies like the US, and some exposure to the emerging market growth stories we discussed. But here's the advanced move. Also, diversify across policy environments. Have some assets that benefit from aggressive monetary easing, some that thrive in stable rate environments, and some that can handle inflation surprises. Second strategy, and this is crucial given the central bank moves we're seeing, position yourself for what I'm calling the Great Rate Transition. We're likely entering a period where different central banks will be moving at different speeds and in different directions. Practically, this means if you have any variable rate debt, credit cards, adjustable mortgages, business lines of credit, now is the time to either pay it down aggressively or lock in fixed rates where possible. Lower rates might be coming, but they're not here yet, and the transition period could be volatile. On the investment side, consider what I call rate-sensitive value plays. These are high-quality companies in sectors like real estate, utilities, and infrastructure that have been beaten down by high rates, but could see massive revaluations as rates fall. Third, and this might be the most important decision you make this year, you need to decide right now how you're going to handle currency exposure. With trade imbalances reaching critical levels and different countries taking different policy approaches, currency movements could dwarf stock market returns. If you have significant international investments and you haven't thought about currency hedging, you're essentially making a massive bet on currency movements without realizing it. That might work out, but it's not a strategy, it's just luck. My recommendation? For your core holdings, consider currency-hedged versions of international funds. For your opportunistic investments, embrace the currency exposure as part of the total return potential. Fourth, don't let developed market problems blind you to emerging market opportunities. South Asia's projected 6.2% growth isn't just a number. It represents companies and sectors that could dramatically outperform over the next several years. But, and this is crucial, don't just buy a broad emerging market fund and hope for the best. The dispersion between winners and losers in emerging markets is massive. You want exposure to specific themes, infrastructure development, digital transformation, and domestic consumption growth. Look for companies that benefit from the structural trends we discussed, not just the cyclical growth numbers. Now here's where I need your help to make this community even stronger. I want you to pause this video right now and think about one specific economic indicator that you're going to start tracking based on what we discussed today. Are you going to watch Chinese retail sales as an indicator of global supply chain shifts? Are you going to track central bank policy divergence as a currency trading signal? Are you going to monitor South Asian infrastructure spending as an emerging market opportunity indicator? Whatever it is, I want you to comment below with your choice and why you think it's going to be important. But here's the challenge. Don't just tell me what you're watching. Tell me what specific action you'll take if that indicator moves in a particular direction. For example, don't just say, I'm watching inflation data. Tell me I'm watching core PCE inflation. And if it drops below 2.5% for 2 consecutive months, I'm going to increase my exposure to growth stocks and consider refinancing my mortgage. This isn't just about engagement, though I do love hearing from you. It's about accountability. When you commit to a specific action based on specific data, you're much more likely to actually follow through instead of just passively consuming information. Don't forget to subscribe and see you on the next video.